Well, good morning all. Good morning or good afternoon all. Hope all of you, your family and friends are well. My name is Thales Stucchi and I'm a tax partner in the tax practice group of Trenchi Rossi Watanabe Advogados. It is a pleasure to have you all in our already traditional international conference for multinationals, now for the first time in an online edition in view of this current situation that we are all facing. Before starting addressing the topic of this session, I would like to take this opportunity to present, especially to our Portuguese-speaking audience, in first hand, our ebook on current international tax matters that is being launched today. The ebook is a compilation of articles written by the tax team of Trenchi Rossi and Watanabe, reflecting our experience on cross-border transactions. Some of the topics that are addressed in this ebook will be discussed in this conference. For other topics that are not expressly addressed in the ebook, we will organize and invite you to join separate webinars. For all topics, of course, the authors are happy to organize separate discussions with you if you feel that might be interesting for your business. The ebook will be available for download at our website, Trenchi Rossi Watanabe website, and soon we'll make this available also at the Kindle platform at no cost. You will also receive a link for downloading the ebook along with the record of this presentation. We hope that you enjoy and feel free to reach out if you'd like to, to discuss any of the topics in more detail with the respective authors. Okay? Well, in the second session of the event, we would like you to bring a discussion on the current developments and current status on tax reporting obligations in Brazil and Europe, especially in relation to the so-called mandatory disclosure rules, which are rules applicable not only to taxpayers, but also to tax advisors or intermediaries. In addition to this topic, we'll try to present you with a status on where we stand in relation to the regulations on exchange of tax information, especially in view of the recent developments on Brazilian regulations and updates on tax treaties. As you are already aware of, in the last 15 years, countries have been moving away from concepts such as tax secrecy that once upon a time were sacred ones. Now, and especially after the BEPS, countries and tax authorities have been pushed, especially by public opinion, and here you can recall the headlines on tax structures implemented by some of the big tech companies, to create more and more regulations demanding taxpayers to come forward and disclose their tax structures, especially the ones involving cross-border transactions. More and more, we are setting the foot in an era of full transparency in the tax world. Of course, regulations to deal with this new scenario have been issued around the globe, but their impacts are yet to be seen. Many of these regulations are inspired by the recommendations stated in the BEPS Plan number 12, that, in short, demands countries to implement domestic regulations on mandatory disclosure rules. Together with the enactment of such rules, we have the development, also inspired in the BEPS, of an increasing number of regulations dealing with the exchange of tax information, as well as other ancillary tax obligations aiming to create an environment of full transparency by the taxpayers and increase cooperation between tax authorities. Evidently, that these new rules and regulations bring an extra dose of complexity and responsibility to the taxpayers and tax advisors. In order to address this new scenario, this new moment, we have here a group of professionals to discuss it from a Brazilian and European perspective. In this regard, I would like to introduce you to my colleagues, Telírio, Philip, and Yuka. Philip Leon is a partner in the tax practice group at the Baker McKenzie office in Brussels, and former head of the EMI tax transactions practice group of our firm. In addition to his role within the firm, Philip is also a lecturer on international tax planning at the Solvay Brussels School of Economics and Management. Yuka Caroline, and sorry, Yuka, sorry if I misspoke your last name, on his turn, is a partner in the London Tax Department of Baker McKenzie, and also a co-leader of the UK transfer pricing practice of the firm. He has extensive experience in the transfer pricing practice, including working experience in several jurisdictions, such as UK, Finland, and Australia. Philip and Yuka will address the topic of this session around the recent enacted European Directive DAC 6, which may bring a lot of concerns to Brazilian taxpayers and tax advisors doing business abroad. Finally, Telírio Saraiva is my colleague in the tax practice group at Trenchi Rossi Watanabe. Telírio is a graduate from Universidade de Salvador and also holds a master's degree from FGV. Introductions done, let's move to our topic of discussion. Well, in this first slide, I'm gonna make a brief presentation on where Brazil stands in relation to the mandatory disclosure rules. Another comment. If you please feel free to submit any questions or comment in our Q&A box that we'll try to address in the end of the session. And if you have no time left, we're gonna contact you offline to discuss your comments and questions. Okay. Well, for the moment, Brazil does not have any kind of mandatory disclosure rule on tax planning enacted yet or in place yet. One of the concerns we have here in relation to the implementation of such kind of rules in Brazil is still the absence of a clear concept of what is considered an aggressive tax planning for Brazilian purposes. In the last couple of years, we have been facing a lot of uncertainty in relation to what could be aggressive tax planning in Brazil. Tax authorities, as you probably are aware of, are adopting a very restrictive approach and trying to enforce concepts such as substance over form, business purpose, even on structures that are implemented by the taxpayers in full compliance with the regulations, and also in some cases, structures implemented align with some stimulus given by the law, such as the case of the goodwill amortization. However, this uncertainty around the concept of aggressive tax planning did not stop the tentative to implement a kind of mandatory disclosure rule in Brazil. I understand that in order to have an implementation of this kind of rule, we would need first to have a more clear concept on what could be considered, or at least the hallmarks to what could be considered an aggressive tax planning. As you may remember, in 2005, inspired by BEPS Plan number 12, the Professional Measure 605 was a tentative to implement this kind of rule in Brazil. That tentative was heavily challenged by taxpayers and the academics in view of the lack of objective hallmark to define on what could be an aggressive tax planning to be reported by the tax authorities. As you remember, according to the then proposed wording of the Professional Measure 605, virtually any kind of arrangement that led to a tax saving could be targeted for disclosure. Of course, such broad and vague wording would be a cause of uncertainty to taxpayer, even more with the heavy penalties that were provided in such provisional measure. Moreover, another discussion that was caused with the enactment of Provisional Measure 605 was based on terms of its unconstitutionality, given based on the fact that obliging taxpayers to disclose their tax planning could be somewhat considered a kind of self-incrimination, which is a concept applied not only to criminal matters, but also to civil and, of course, tax matters. And as you know, this situation is prevented by the Brazilian Constitution. In this regard, at least in my opinion, I believe that was good that such Provisional Measure 605 was not converted into law. Fact is that even though with the absence of a specific mandatory disclosure rules in the terms provided by BEPS, Brazil has been enacting along the years a series of regulations and practice that demands taxpayers to be more and more transparent in relation to its activities. One example of it comes with the implementation, a long time already, of the SPED, which provides the tax authorities a full range of information that make possible the identification of tax practice that may lead to a characterization of an abusive or aggressive tax planning. Also, for cross-border transactions, Brazil has put in a focus on the enactment of relevant regulations allowing taxpayers to provide a faster and more complete exchange of tax information with other jurisdictions. Examples of it are the country-by-country report provided in normative ruling 1861 from 2016, inspired in the BEPS Plan 13, the E-Financeira, and the CRS normative rulings 1571 from 2015, and the normative ruling 1680 from 16. In addition to that, I remember that Brazil has been also updating its tax treaty network in order to facilitate the exchange of information with other countries. And we have already seen a lot of activity in this regard, including with practical cases involving some of our clients in this topic of exchange of information based on tax treaties. In order to comment this development in Brazil on cross-border exchange of tax information, as a face of this new era on tax transparency, I pass the floor to my colleague, Telírio. Telírio, please.
Thank you very much, Thales. Can we jump to the next slide, please? Thank you. Good morning, everyone. Thank you very much for attending our panel here today. So we're going to talk a little bit about exchange of information from a Brazilian tax perspective. And to begin with, we choose to show you this print screen. It was taken on the OECD's website, more specifically on the Global Forum Transparency website. They have something there called country monitoring. And they have an interactive map where you can click on each member jurisdiction of the Global Forum Transparency and appears a brief summary of the level of compliance of that jurisdiction with OECD's initiatives. So when you click on Brazil, that's what you see. And what that screen tells us. First, it tells us that Brazil is considered to be largely compliant with OECD's initiatives when it comes to exchange of information by request. It also acknowledges that Brazil is now part of a mutual administrative assistance convention, which is a huge convention. We're talking about here 130 countries that makes part of this convention, and also states that we now have today in Brazil automatic exchange agreement specifically regarding the exchange of financial information, financial assets and income under the Common Reporting CRS standards. So this tells us that in the view of the OECD, Brazil is today considered a member of the Global Forum Transparency that significantly contributes to global transparency. It's the kind of status that we didn't have maybe 2 years ago, and now we have it. So Brazil is now part of this global network on transparency. And the Brazilian IRS and the Brazilian government is really investing efforts in this direction, not only with the purpose of collecting tax in Brazil, but it's no secret that Brazil wants to join OECD. So, and it's no secret also that transparency plays a significant role when it comes to this process of join OECD. Thales, can you move to the next slide, please?
Sure.
All right, so this is an objective evidence that we are getting. We are investing a lot of efforts on being part of this global network on transparency. When you put together all the normative initiatives taken by Brazil in the past few years, this make very clear. First, of course, I have already mentioned the previous slide. Brazil has joined OECD Convention on Mutual Administrative Assistance in Tax Matters. There's a convention that provides many guidelines to all sorts of procedures regarding the exchange of information between foreign tax authorities. We are talking about here exchange of information by request, automatically, even spontaneous exchange of information. The official goal of this convention is to combat tax avoidance, and tax-based erosion, and Brazil is part of that. Also, we signed multilateral agreements regarding the automatic exchange of financial information, the CRS. We have, in the same line, signed a multilateral agreement regarding the exchange of CBC reports. We have signed specific tax information exchange agreements, the so-called TIAs, with many countries, even with countries that we don't have double tax treaties. For instance, we have one with the United States. And by the way, with the United States, we have a specific agreement regarding the exchange of information and the FATCA. This is very important. This is happening. And of course, in our double tax treaties, we have on Article 26 provisions regarding exchange of information, and we are now updating some of these double tax treaties in order to improve the mechanisms under the treaties of exchange of information. So if we jump to the next slide. Very good. So we have OECD recognize us today as a relevant member of this global network on transparency. We have now a very solid normative background. And for the first time, the Brazilian IRS has published some of the concrete results regarding this, the use of these multilateral and bilateral agreements. And for those who doesn't know, annually, the Brazilian IRS issues an audit. So in the 2018-2019 reports, the Brazilian IRS had some very high level and overall comments regarding this exchange of information process. But in the latest audit report, the audit report regarding year 2020, for the first time, Brazilian IRS present numbers. So it seems that we are receiving and giving away a huge volume of data. Just regarding financial informations, we receive more than 900 information regarding more than 900,000 bank accounts. Under FATCA alone, we received more than 6,000 information about accounts held in the US. And under CRS, we exchange information with more than 90 countries. We receive almost 900,000 data of bank accounts. And a curious thing is that we are exchanging information even with low tax jurisdictions like Bahamas and Cayman. It shows that even the low tax jurisdiction, the traditional low tax jurisdictions, they are now adapting, evolving, they're changing their business model in order to be in compliance with OECD transparency standards. CRS is now even dictating how the low tax jurisdictions are going to do business now and in the future. And in parallel, so the first thing is today this exchange of information is very focused on financial information. And under the CRS, for instance, this is happening automatically. But also we exchange with more than 10 countries CBC report, which is not limited to financial information. We have account information, we have revenue, profits, even number of employees. And we exchange this kind of report with other countries, which is a very rich source for the Brazilian IRS and foreign IRS to assess, for instance, economic substance. So this kind of information is now available to the Brazilian IRS, and we are using it. Thales mentioned before, I can give you some brief examples from our practice here in the office. For instance, we have a client that received a tax assessment solely based on information provided by the US Customs Office. We received the tax assessment, and when we read it, it was very clear. The Brazilian IRS requested to the US Customs Office ancillary obligations submitted in the US and used that information to impose the collection of taxes in Brazil. So that was a very good example. In this case in particular, we didn't have even a tax audit procedure before the tax assessment. We received directly the tax assessment based on ancillary relations based on a foreign ancillary obligation, US ancillary obligation. In another case, it occurs the contrary. We have a client that moved to Spain. And in Spain, the Spanish tax authorities began a tax audit there. And in the context of the tax audit, the Spanish IRS requests the Brazilian IRS information. And the Spanish IRS used the information to challenge our client in Spain. And the last example I can give you, we are now working a tax audit. And the tax auditor told us that he knew that our client had a subsidiary in a European country and that our client had a tax ruling in a European country. And he told us that he has already requested the European country to share the tax ruling. And the tax auditor told us that he was going to thoroughly analyze the tax ruling to assess the subsidiary economic substance. So Brazilian is receiving and giving this kind of information, and our IRS is starting to use it, as foreign IRS is also using information provided by the Brazilian IRS. So I think the main takeaway here is for all of us, individuals, legal entities, all taxpayers, to acknowledge that information now is global. What you submit abroad may imply tax consequence in Brazil and vice versa. And we should incorporate that on our tax compliance routine and also our tax planning routine. This is a reality and we should acknowledge that. It's very relevant that we incorporate this to our work. So this was a little bit about exchanging information from Brazilian tax perspective. I'm going to pass on to our European colleagues, Hugh and Philip, to tell us a little bit what's going on in Europe.
Well, thank you, Telerio and Thales. Can you hear me? So together with Yuka, we indeed are going to walk you through the latest transparency developments in Europe that you heard the name DAX 6. And we're going to come in a minute to what it means and what it means in practice. But before that, we just provide you with a brief overview of all the transparency initiatives that we're taking in Europe in recent years, because Europe has been very active on the front of transparency. For those of you who participated in this conference in earlier years, you will recall that one time we discussed the introduction of a mandatory exchange of rulings that, of course, caused a lot of commotion, because all of a sudden, when you had a ruling with a European country, you knew that this ruling was about to be exchanged. What would that mean, etc.? So we discussed about that. There are a lot of initiatives, of course, in the EU on transfer pricing, country-by-country reporting, local and master file. There was the introduction of an ultimate beneficial ownership register, where all companies have to identify the ultimate beneficial owner, common reporting standards, local and joint audits. So as you see, CRS, there are a lot of initiatives that have been taken in Europe, but the latest one, the so-called DAX 6, is by far the most complex one, the most far-reaching one, and probably also the most controversial one, as we will see. Now, if we can move to the next slides, I mean, the European Union, we're very proud of announcing the introduction of DAX 6 because of what it would be able to achieve. Now, what does DAX 6 mean? The name stands for the fact that this is the sixth amendment to the so-called Directive on Administrative Cooperation. That's the reason for the name DAX 6. Basically, it introduces mandatory disclosure of what is being defined as potentially aggressive tax planning. So what needs to be disclosed is not necessarily earmarked as being aggressive, but these are all situations, and we will call them hallmarks, and Yuka is going to walk us through the hallmarks as being identified as situations that are potentially aggressive tax planning. And the novelty here, of specificity, is that the reporting does not need to take place by the taxpayer in first instance, but the burden to inform the tax authorities about those arrangements, that cross-border arrangement, as we will see, that meet certain hallmarks, that burden falls on the intermediaries. And intermediaries that can be lawyers, tax advisors, bankers, investment bankers, anyone that is involved in a transaction and that is kind of dealing or is the information and is participating in the design of what will be, or in the implementation of what will be seen as a reportable cross-border arrangement. So it only taxes a cross-border situation. We'll see their exception, and only if they meet certain hallmarks. Now, the directive sets a minimum standard, and that's important. As any directive, it sets a minimum standard, but member states, so they have to introduce in their local legislation, or they had to introduce in their local legislation, the rules provided in the directive, but they had the possibility to go even further than that. And we will see briefly, we'll not go into the details, that some countries went beyond what the directive was asking as a minimum standard. Now, as I said, it needs to be reported normally by the intermediary, but there are situations, and Yuka will explain that, where either there is no EU intermediary, so the advisor that is involved has no connection with the EU, or there is no intermediary, or if there are EU intermediaries, they are protected by the legal professional privilege under the domestic legislation that prevents them from disclosing to the tax authorities what they're doing for their clients and the planning that they're advising on, when in all these cases, the obligation to report will fall on the relevant taxpayer, meaning the entities in Europe that are participants in that arrangement that qualify as a reportable arrangement. Now we will see the timeline. That directive was passed in May 2018. It was applicable as from the 1st of July 2020. And normally as from the 1st of July 2020, we started to report, but there was a delay because of COVID and everything. And therefore we'll see the actual reporting will in most countries be delayed to later. Now, importantly, when the directive was introduced, there was a long time gap. It applies as from the 1st of July, but it also forces you to look at all situations where an arrangement has been implemented, of the first step of implementation has been made since the 25th of June 2018 until the 30th of June 2020. And as I said, the directive kicks in on the 1st of July on an ongoing basis. That long period of 2 years is what we call the look back period, which forces all intermediaries, all lawyers, all tax advisors, all clients to have a look at all the transactions, all the arrangements that have implemented in that period and that might potentially fall within the scope of that directive. If you fail to report, there are penalties, and as we will see, the penalties are meant to be substantial, to really be dissuasive. So that in a nutshell is what we're going to talk about. And now I'll pass the word to Yuka to walk you through the details of how to approach Tax 6 and what the steps are that you need to consider. Yuka, over to you.
Thank you, Philip. That was a very good and comprehensive introduction. We will go into more detail in certain areas and probably skim over the others. But let's start by looking at how you go about determining whether or not Tax 6 actually applies. So there are a series of questions that you answer, which then will determine whether or not you actually are looking at a transaction that or an arrangement that should be reported. So the first question is whether there is a cross-border arrangement. And as Philippe already mentioned, Tax 6 applies only to cross-border arrangements that involve either 2 EU member states or an EU member state and a third country. So you need a connection or an access with EU in order to fall under the directive. Now, if you meet that threshold, then there's the list of hallmarks that Philip already mentioned, which we'll look at in more detail in a little while, to see whether or not you meet those hallmarks. And some of the hallmarks are also subject to what is known as the main benefit test. Again, something we'll look at in more detail to determine whether or not you need to report the arrangement. Now, if you answer yes to the first 2 questions, then the question is who should report? Again, something Philip touched on, we'll go into more detail. And then what information should be reported? So that's basically the framework you're looking at in terms of starting to dig into the world of Tax 6. But let's move on to the next slide and look a little bit more in terms of the key terminology here. So we're talking about a cross-border arrangement. So the term arrangement is not defined in any of the actual directives or any of the guidance, and they've left it very wide on purpose to basically capture all kinds of tax-driven arrangements. They talk about meeting the dynamic nature of tax avoidance. But again, we'll talk about that in more detail, but you'll see that having left this very wide and bringing in a variety of hallmarks, they've actually cast the net really wide with this. So an arrangement will be under Tax 6 if it meets at least one of the hallmarks. And then the question is whether or not it's a cross-border arrangement. and that we've already touched briefly, but it looks at the tax residency or a presence in a jurisdiction. So basically, you need to have some sort of taxable presence in an EU country in order to fall, so to speak, foul of this. And then moving on to the hallmarks, which is where this, I think, starts to get a bit more interesting. So if I can have the next slide, please. So we've got all of 19 hallmarks. Some of the hallmarks require the main benefit test to be met, some don't. You'll see on the slide here that we've color-coded the hallmarks that require the main benefit test, which is the thing we're going to talk about next. And then, so you can see that, interestingly, about half of the hallmarks don't even require the main benefit test to be met. So actually, the achievement of tax benefit doesn't actually matter with about half of the hallmarks. So you may fall foul of the reporting requirements even if the arrangement wasn't tax driven. The hallmarks are split into 5 different categories marked A to E on that slide. The A and B categories are hallmarks that are subject to the main benefit test. The A hallmarks target relationships between taxpayers and tax advisors in respect of tax avoidance. So this is where we're talking about specific tax avoidance. And the B hallmarks look at certain specific types of tax planning, like loss buying or artificial transactions. The C hallmarks relate to cross-border transactions, and these are the ones that are usually most relevant to multinational groups. They target base erosion transactions, like tax deductions being obtained on a payment where the income is not taxed by the recipient. Then we have the D hallmarks, which are targeted arrangement that undermine reporting obligations under the common reporting standards, and also transactions that seek to obscure beneficial ownership. So that's more of a sort of wider reporting related hallmark. And then the final set of hallmarks under letter E there are the transfer pricing hallmarks. They do not require a main benefit test to be met. And that is important to keep in mind because the transfer pricing hallmarks actually can have a very broad effect. And we'll have some case studies discussing these, and we'll touch on, for example, the hallmark that talks about the hard to value intangibles. You'll see that it can get quite interesting in relation to the application of the hallmarks. So I guess to finish on the hallmarks, just the point I already made, they are very broad and they may capture commercial transactions that have no tax motivation at all. So that is important to keep in mind when you're looking at your potential reporting requirements, that you don't necessarily need a tax avoidance motive. But that, I guess, leads us to talking about the main benefit test. If I could have the next slide, please. There we go, thank you. So the main benefit test is satisfied when the main benefit, or one of the main benefits that can reasonably be expected to be derived from an arrangement, is the obtaining of a tax advantage. So this is an objective test, which means that it's not necessary to examine the specific motives a person had when they were entering into an arrangement. What matters is that you can obtain a tax advantage, or obtaining of tax advantage is the main benefit, or one of the main benefits that may reasonably be expected. So you don't have to have a tax driver, but if you are obtaining tax benefit as a main benefit, then you are likely to meet the main benefit test. There's also no de minimis on the main benefit test. So there's no monetary or numerical value that you could look at and say, if I gain a benefit that's less than certain number, I'm sort of protected. So that should be kept in mind as well. So what you need to do is to look at the arrangement as a whole, and consider both sides and any principles of the relevant legislation. So this really looks at the arrangement as a whole and sees or tries to see whether it is tax driven or could be tax driven. We got some questions on the next slide in terms of talking about, key issues on main benefit test. I don't know, Philip, if you wanted to touch on these briefly.
Yeah, the main benefit is indeed, once you're in there, one of the most complicated to apprehend it. As we will see, every country will issue guidance, and the guidance may be different in the various jurisdictions. And some of the questions that you have to ask yourself are around this slide. The first one be it, does the tax benefit need to be within the European Union, be achieved within the European Union in order for the main benefit test to be met and therefore the hallmark to be fulfilled in those cases where it's necessary? Well, there diverging view, or there may be diverging view in jurisdictions. In some countries, it is clearly confirmed that yes, a tax benefit obtained elsewhere will be taken into account to determine whether the main benefit is fulfilled. Other countries may have a diverging view, and that's where I tend to the complexity I was looking. Does the tax benefit need to result from the cross-border nature of the arrangement? That in itself is not a requirement, but somewhere in some of the guidance, it's provided the simple fact that you are using a rule that is existing in a jurisdiction, but you don't structure the arrangement around that rule and around obtaining that rule, that may be okay. But so it's all kind of details you need to look into the guidance. The question is sometimes if you have a local tax benefit, but there is a compensation elsewhere, do you need to look at it on a consolidated tax basis or not? Well, from the perspective of one jurisdictions and the administration in one jurisdictions that require the intermediary that are in that jurisdictions to report, that may not necessarily be so in their local guidance. A tax deferral, could that be a relevant tax benefit? Again, in some guidance, they will say, yes, a tax deferral is relevant. Other guidance may have a different view. And then the question is, does the benefit need to be abusive or against the spirit or intention of the rule? Where clearly, as Yuka was saying, the purpose of the directive is to make it an objective test, so that the only thing you need to look at is, can I reasonably be expect to obtain that benefit if I enter that structure? And if that's the case, objectively, you would consider that the main benefit is fulfilled. There does not need to be an abusive intention. There does not need to be, it does not need to be against the spirit of the rule. No, I guess when you look at some of the guidance, and I guess it's for the situation where you would not have reported, I think tax administration would certainly intervene if they consider that in the specific case that might not have been reported, the situation was clearly against the intention of the rule there. They will certainly come in between. And I guess then we need to move to the next slides where Yuka will walk us through the who is to report and by when.
Yes, thanks, Philip. So we've gotten as far as being certain that we've got an arrangement in our hands that needs to be reported, and then the question is who reports the transaction. So, and as Philip mentioned already at the beginning, so the reporting requirement sits squarely with the intermediary in the first instance. So they have the primary reporting obligation. And intermediaries, and it's listed on the slide as well, it's a bit burdensome, but I'll touch on the text anyway. So they are those that are involved in advising or implementing cross-border arrangements. And it can be any person that designs, markets, organizes, makes available for implementation, or manages the implementation of a cross-border arrangement. So basically, it's a very wide net, and even talks about persons that know or could reasonably be expected to know that they provided directly or by means of other persons aid, assistance, or advice in relation to these types of arrangements. So basically, any type of tax advisor is easily within that net, but it can be a number of other intermediaries as well. The main thing to remember, and we've already said this before, but just to remind you that this requires an EU nexus. So you have to be resident or incorporated in an EU member state. But also membership in a professional body can count towards this. So for example, if you're a lawyer and you practice under the SRA rules in the UK, even if you're a foreign lawyer, but you've got the practice rights and you're registered in the UK, that gives you a nexus in the EU, at least for the time being until Brexit happens, and then we don't know whether or not that still gives you a nexus. But that's a different strain of conversation. I'll just drop the Brexit point in at this point. So currently we don't have what's going to happen specifically in the UK with DAC 6, but the understanding is that UK will uphold a similar reporting requirement even after the UK leaves the EU. So this will be relevant from a UK perspective, or for anyone who has business in the UK. Yeah, so then coming back to the reporting and the intermediaries. So it is possible that there are multiple intermediaries working on a case. So for example, you can have several advisors working on the same project. In principle, then you only need to file one report in one member state. But that is under the assumption and requirement that all intermediaries receive proof that that report has been made. So the intermediaries can agree that one intermediary files a report, but then everyone has to have proof of that filing in order for the reporting requirement to have been satisfied. Now, if there is no external intermediary, for example, when a group company acts as an intermediary, so it can be let's say a treasury company that, so to speak, markets or implements arrangements that fall under the reporting requirement, then the reporting requirement will be with that group company or a group company that's affected with the transaction. Again, provided that you've got the EU nexus. Same thing with if the intermediary is not in the EU. So again, in that case, the requirement will fall on the taxpayer who has the nexus. And also on the legal privilege. So what is interesting about legal privilege, lawyers are used to operating under legal privilege and claiming that we can't disclose information that's under legal privilege, and we can't then report arrangements that may be subject to legal privilege. The rules on DAC 6 do not require the disclosure of legally privileged information. So a lawyer will not have to disclose legally privileged information. However, the reporting requirement is there. So it's either a question of reporting based on the fact that you've got information. So if you're a lawyer, you've got information that is not subject to legal privilege, and that allows you to make the reporting, or if it is legally privileged information, then you have to either advise the taxpayer or another intermediary who will make the reporting requirement or meet the reporting requirement on your behalf. It is possible for the taxpayer to waive the privilege and allow filing under privilege, but obviously that will have different ramifications into which we won't go now. And on that, I'm also conscious of the time. Let's look at the timeline really quickly before we move into the case studies. And why don't we jump straight to the second timeline slide. So basically, this is what, in line with what Philippe was talking about. So the regime applies from 1st of July, but in response to COVID, most of the EU member states agreed to allow for a 6-month deferral. And I say most because Germany and Finland didn't, and Austria and Poland, I think, are still out considering what they're going to do. But if we look at the member states where there is a deferral, then the standard reporting will commence on 1st of January 2021, as Philippe was saying, and reports must be filed within 30 days of one of the following triggers. So on the day the arrangement is made available for implementation, or on the day after the arrangement is ready for implementation, or when the first step in the implementation of the arrangement was made. And service providers need to report within 30 days, beginning on the day after they provided directly or by means of other person aid, assistance, or advice. So that's basically the reporting timeline. And I know everyone's going to get the slides, so I don't think we need to stay these much longer. I think I'll just quickly hand over to Philip to move over to the case studies, right, Philip?
Yeah.
Oh, we got the local variances first.
Yeah, just some variances before we move to the case study. So as I said, the directive imposed a minimum standards, and now member states have implemented the directive. Most of them kind of really line per line, but there are some variances. For instance, in some countries, domestic transaction or purely domestic transactions may be in scope as well. That will, for instance, be the case in Poland. Taxes, usually VAT and custom duties is not the scope of the DAC 6 directive as provided under the directive. But again, there are certain countries where VAT planning or planning around custom duties may trigger its own hallmarks and therefore be reportable. That's again the case of Poland and of Portugal. Now, watch out with this. It's not because an intermediary is providing an advice just on VAT that intermediary may not be subject to the reporting obligation if he realizes that advice fits within a reportable arrangement. So what I mean here with tax within scope, it's the hallmarks itself. There are no hallmarks for VAT and custom duties except in certain countries. On the interpretation of the hallmarks, as we will see, I mean, there is guidance in the various jurisdictions, the variance is different. So what may be found to be reportable in one country will not be found to be reportable in another country, even with the same legislation. So that increases the difficulty. The interpretation of the main benefit test may be different, and the rule with respect to legal professional privilege. So that's an important one because as Yuka said, if there is legal professional privilege, the intermediary may not report, but has to inform the client or other intermediaries if there are other intermediaries that they have to report. Now, in that respect, there are three categories. There are countries where there is the strict legal professional privilege, so that's the rule. There's a country like Germany where there's a dual system, meaning that the German intermediary needs to report on a no-name basis, and then the taxpayer will have to report himself with the unique reference number that was provided by the intermediary. And then you have certain countries like Belgium, where the legislator has considered that DAC 6 reporting does not breach the legal professional privilege for the reason that they say legal professional privilege is to protect you or being able to protect the taxpayer from going to an advisor to say, well, look at my situation. How am I doing? Do I have a problem? And here they say, well, DAC 6 is about the future, is about something that you have not implemented yet. It's about planning for the future. And that, according to the Belgian legislature, does not fall within legal professional privilege. And that is now subject to criticism and to a petition with the Constitutional Court, but it is as the law stands. And of course, as to the level of applicable penalties, in the next slides that you will see, when you receive the slide, you will see that they need to be dissuasive, but there are quite some differences between the countries. On average, you can see that sometimes it's progressive, but you can have fines per instances that can go from 25 to 50,000 euro for late filing or non-filing or incomplete filing. But you see, by contrast, in country like Ireland, where the fine is limited to 5,000 euro, and you may wonder whether that is really dissuasive and whether that is really what the directive was about. Now, if we move to the case studies, we have included 5 a small case study just to give you an idea of the type of structures that may come into play. 2 of them are generic, 3 of them are really focusing on Brazil. The first one is a situation where you would have a Brazilian parent that has two subsidiaries, one in the Netherlands and one in Belgium, and there is a cross-border merger between the Netherlands and the Belgian entity, whereby the Belgian entity is absorbed by the Dutch entity. And of course, when you have a cross-border merger, all the assets are being transferred to the other entity. Now, cross-border merger can be done with or without the maintenance of a PE in the country that is being absorbed. Now, the interesting thing here is when you look at these schemes, what potential hallmark could come into play. I say in the facts, the fees are contingent on meeting certain time milestone. There was a hallmark about contingent fee, but it's only when the contingency was linked to the tax benefit. So this is not a hallmark that apply here. Transfer of hard to value intangible, well, you have to see in the Belgian entity, is there any hard to value intangible? And if there is a hard to value intangible, is it being transferred to the Netherlands? If that's the case, well, hallmark E2 could play in this case. E3, transfer of functions and assets and risk. And as a result of the transfer, the EBIT of the entity drops below 50% of what it would otherwise be. Well, that is again a hallmark that could potentially play in this structure. If you look into the Belgian guidance, they say not if the assets are being kept into a branch. If you look into the Dutch guidance, that takes more kind of a legalistic approach or approach linked to the entity. The Dutch guidance seems to say that as soon as the assets are moved from one country, from one entity to the other, the EBIT of the entity that disappears, of course, is reduced below 50%. So that might need to be reported. So you see a lot of complexity for what would otherwise be a simple case. Now, maybe moving to the next one, and that one is for Yuka on transfer of IP.
Yes, thanks, Philip. I'm conscious of the time, so I'll make this quick. So you'll see on the slide the setup. So we are transferring IP that has not yet been commercialized between two overseas related group companies in order to benefit from a better IP regime. And then you have an IP lawyer involved in registration process locally. And the local entity now pays royalties to low taxed company in Switzerland. And then you start to look at the hallmarks. And here the crux is really on the hallmark E2, which is the transfer pricing hallmark on hard to value intangibles that I briefly mentioned as I was flying through the hallmarks earlier. And the hallmark only applies where there is a transfer of an intangible asset, and that is a transfer of hard to value intangible. So in order to satisfy yourself for whether or not the hallmark applies or not, you have to look at the OECD transfer pricing guidelines guidance on what is a hard to value intangible. And basically, without going into great detail in there, it is an intangible that at the time of the transfer, there's no reliable comparable, and the projections of future cash flows or income expected were very difficult to predict. And so if you start to determine whether or not that hallmark applies, you have to look at this from an external perspective and basically act as if you were an sort of a hypothetical informed observer to see whether or not this was indeed a transfer of hard to value intangible. Obviously, on this slide, we don't have enough detail, but potentially, because it's a not yet commercialized IP, potentially you will meet the hallmark E2, and then this is a reportable transaction. There's also the question on the payment, which will obviously be linked to the main benefits test. But this just shows that you've got the layers, especially on transfer pricing hallmarks, you've got several layers you have to look at, and you also have to look outside the immediate directive text, in this case to the OECD guidelines on what they say about hard to value intangibles. But as said, based on the brief summary on this slide, this looks like a reportable transaction. And Philip, I'll hand back to you for the next one.
So moving to the next one, which is of course a typical one for Brazil multinational. This is so the typical situation where you have an agreement in place where the Brazilian entity will sell its non-commodity goods to the Austrian company at cost plus 15%. Then the Austrian company will sell these goods at market price, but then based on the ruling will be taxed only on an arm's length profit, and the difference will be considered informal capital contribution by the Brazilian co, and therefore there will be some nowhere income as is now being called. Well, that is a typical structure where two hallmarks potentially come into play. And the one is E1. You will remember use of unilateral safe harbor rules. Now, what is a unilateral safe harbor rule? A unilateral safe harbor rule is a rule, is when the entity, the Brazilian co here, is authorized to rely on a rule that departs from the normal TP rules that would apply to other situation or the general situation in Brazil. So any specific derogation that apply only to a category of taxpayer or to certain transactions, and that is not in line with the commonly accepted TP rules under the transfer pricing joint forum, that will be seen as a unilateral safe harbor rule. So if that's the case here, that's reportable even without any main benefit test conceptually, or potential cross-border mismatch for asset transfer. Well, that depends if you use different price contractually, but I guess that's not the case. But again, it's one of these hallmarks that you need to include in the analysis. Now you will say, well, this is kind of scary. Obviously, you always have to remember that the directive only applies for arrangements or new arrangements put in place after the 25th of June 2018. So technically, if you have an existing structure, you have a solid contract between the Brazilian co and the Austrian co that, you know, explains under which conditions non-commodity goods are being delivered, and that contract dates from before 25th of June 2018, then you have a good argument to say that this is not reportable. But if there is any change to the contract, if the contract in itself is subject to any deviation, and certainly under the interpretation of some countries like Poland, etc., this is something that might need to be reported. Moving to the next one is a structure that I believe is also now quite heavily promoted to kind of get the holding function from underneath an Austrian co back to a Dutch co in order to shield it from future capital gain taxation in Austria. Well, if you have that type of structure, you'll have to ask yourself the question, if an advisor approaches you with this type of arrangement, can this fall under the standardized tax arrangement hallmark? In looking at the situation, we have to see, is there a cross-border mismatch in the consideration for the asset transfer? Probably not the case here. And then the last one is, there is a transfer from the shares. And if the transfer would be directly to the Dutch co, and it's a cross-border transfer, the question would again be, is it an E3 hallmark, i.e., will the transfer result to a reduction of EBIT by more than 50%? Now here, there's again interpretation. EBIT is typically does not include interest and dividend. And I believe some countries, in Belgium, for instance, the guidance confirms that if you transfer participations or if you transfer receivable, that does not fall under that hallmark E3, except if you are a financing company or a holding company. So again, so this is a structure that if you are confronted with it, you definitely need to have a look. And then maybe the final one is the so-called payment of interest on equity, case study 4. It's again one of these typical structure. If it was put in place before 25th of June 2018, I would say there is absolutely no problem even if you make a payment after June 2018. If it was put in place after 25th of June 2018, you will need to have a look. I'm not saying that this is reportable. again, you have to look at the possible hallmarks that come into play. But here it's so much linked to the system, the just simply application of the law in Brazil, that I wonder whether this could qualify as an arrangement. But again, if you have it checked, because that is always the recommendation. If we can move to the perhaps conclusion, as you will have seen, I mean, DAX 6 is very complex. It forces you to look back at all the transactions that you have entered into since the 25th of June 2018. Obviously, all intermediaries, advisors that you're working with are busy with that exercise. And our recommendation is also for clients, for multinationals, to do their own homework and to proactively contact their advisors to address this issue. I mean, this is not something to be shy about. I mean, the intermediary will have to report anyway. So the sooner you start the dialogue on these things, the sooner you start to be sure that you have identified the ones that are potentially reportable, and you engage with all the intermediaries that have been involved to be sure that they will all ideally share the same position, because the worst thing you want is to have some advisors saying, yeah, this is not reportable, and another one that you haven't thought of declaring or reporting the matter because they think this is reportable. So again, DAX 6 is something where we really recommend to go out, discuss and interact with all your advisors on this to be sure that this is being tackled properly. Fortunately, with COVID, I mean, that's, if there is one good thing about COVID, is the thing that it has delayed the implementation of DAX 6 by 6 months, which gives some breathing air, not only to intermediaries, but also to the multinationals to tackle with it. But now really is the moment to focus on it. And with that, thank you for your attention, and over to you, Thales and Telerio.
Thank you, Philip. Thank you, Yuka. That was very helpful. Indeed, DAX 6 is a new reality to everybody. It's a new situation that everybody needs to be aware of, including especially tax advisors. So it was, thank you very much for giving us this brief overview and the expectation on the next developments on DAX 6, especially on for Brazilian entities. Just before we conclude, we have only one question that Telerio will present to you in connection with DAX 6 and the exchange of information with the Brazilian tax authorities. Telerio, can you present the question to Yuka and Philip?
Sure, Thales. Actually, I had at least 3 questions, but our time is up. So, in your opinion, you think could DAX 6 information be potentially exchanged with the Brazilian IRS? What do you think about that?
Well, I think that will depend on the, I mean, first of all, and maybe something that we haven't maybe sufficiently highlighted, the intermediaries need to report locally to their own tax administration, but then there is a system that will be in place that all tax authorities within Europe need to put that in a central database and exchange all of that. So the information will freely circulate within Europe. Now, whether a European jurisdiction would communicate with Brazil, whether they would do it proactively or that they would do it on demand, will depend on the bilateral situation with that country. For instance, when I gave the example of the main benefit tax, it has come, I mean, I've heard that, for instance, the German tax authorities take the position that on MBT, etc., they would only communicate it with tax authorities outside of the EU, if that is provided, and they would only take care about a tax benefit being realized abroad if it falls under an automatic exchange of information or exchange of information with that jurisdiction, and otherwise they wouldn't bother.
Philip, thank you very much.
Thank you very much, Philip, Yuka, Telerio. Thank you very much for presenting these topics. I thank you all for attending the session. Again, the session is being recorded, and the link will be provided to you as soon as possible, together with the link for downloading the ebook I mentioned in the beginning of the presentation. Thank you all. Hope everybody is well, and wait to see you or virtually in the next sessions of this text conference. Okay, thank you. Bye-bye.
You.